Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and beside me, as always, is the one who actually reads the balance sheets, Lana Chen.
Good to be here, Hudson. And today we've got a company that touches almost every smartphone on Earth, whether you know it or not.
That's right. Today we are cracking open Qualcomm, ticker QCOM, the San Diego chipmaker that quietly powers the wireless world. And folks, this one is timely.
Very timely. Qualcomm is right in the middle of a massive identity shift, from a smartphone chip company to something much bigger. AI on your phone, chips in your car, processors in your laptop. The question is whether they can pull it off before the old business shrinks underneath them.
So let's get into it. Qualcomm was founded in 1985 by Irwin Jacobs and 6 other engineers right there in San Diego. The name stands for Quality Communications, and they basically invented CDMA, the technology that made modern cellular networks possible.
And that's still the foundation of everything they do today. Qualcomm operates through 2 main segments. QCT, that's the chip business, designs Snapdragon processors for phones, PCs, cars, and IoT devices. It accounts for roughly 75 to 80% of revenue.
And then there's QTL, the licensing arm. They've got over 140,000 patents that are essential to 3G, 4G, and 5G standards. Every phone that connects to a cellular network basically pays Qualcomm a toll.
QTL is only about 16% of revenue. But here's the kicker. It generates nearly half of their net income. Those licensing margins run around 70%. It's one of the most profitable patent portfolios in technology.
Today, Qualcomm is led by CEO Cristiano Amon. They've got over 51,000 employees, and they're valued at roughly $136 billion. Now, Lana, let's get to the numbers because there is a lot going on under the hood.
Let's start with valuation. Qualcomm trades at $127.61 per share. The trailing PE is 25.95 times earnings, but the forward PE drops all the way to 12.116. That gap tells you the market expects a meaningful earnings step-up over the next 12 months.
So the stock looks expensive backward and cheap forward.
Exactly. Price to book is 5.08, EV to EBITDA is 10.07, and the PEG ratio sits around 1.4. For a large-cap semiconductor company, that forward multiple is genuinely attractive if the earnings materialize.
What about the range? Because this stock has been on a ride.
The 52-week high is $205.95. The 52-week low is $121.99. So we're trading near the bottom of that range, down about 38% from the peak. The all-time high was $218.42 back in June 2024.
Ouch. So what's happening with the top line?
Revenue on a trailing 12-month basis is $44.28 billion, up 13.66% year over year. The quarterly trend tells the story, though. Q1 fiscal 2026 came in at $12.3 billion, Q4 fiscal 2025 was $12.25 billion, Q3 fiscal 2025 was $10.2 billion, and Q2 fiscal 2025 was $9.39 billion.
So revenue has been climbing quarter over quarter. That's encouraging.
It is, but the guidance for Q2 fiscal 2026 is $10.2 to $11 billion, a sequential decline. The culprit is a global DRAM shortage that's constraining smartphone OEM builds, particularly in China. Management was clear this is a supply issue, not a demand issue, but it still hits the numbers.
And earnings per share?
EPS on a trailing basis is $4.92. Q1 fiscal 2026 was a record quarter at $3.50 non-GAAP, beating the estimate of 3.40 by about 3%. EPS growth year over year was roughly 3%. Modest, but positive.
Let's talk margins because I know you've got thoughts on this one.
I do, and this is where it gets complicated. Gross margin is 55.4%, solid, but down from over 60% historically. Operating margin is 28%. Net margin is 12.5%, and that's down significantly from the 25 to 29% range we saw in prior years.
What's driving that compression?
Mix shift and pricing pressure. As Qualcomm pushes into PCs, automotive, and IoT, those are lower margin businesses than premium smartphone chips. The QTL licensing segment props up profitability, but QCT margins are under pressure from competition and component costs.
All right, what about cash flow? That's usually where the real story lives.
Free cash flow is $12.93 billion on a trailing basis. FCF yield is 9.5%. That's excellent. For context, that means Qualcomm generates nearly 10 cents of free cash for every dollar of market cap. Very few large-cap tech companies can match that.
And the balance sheet?
Total debt is $14.82 billion. Cash and equivalents are $11.82 billion, so net debt is only about $3 billion. Debt to equity is 0.70, conservative. Debt to EBITDA is 0.85, very manageable. Current ratio is 2.82, which means they've got nearly $3 of current assets for every dollar of current liabilities.
That's a fortress balance sheet.
It is, and they're returning a lot of that cash to shareholders. The dividend yield is 2.8%, $3.68 annually. They just bumped the quarterly payout to 92 cents from 89 cents. The dividend streak is over 20 consecutive years. Payout ratio is 72.7%, which is elevated for tech, well above the sector average of 38%.
Is that payout ratio sustainable?
At these free cash flow levels, yes. But if margins compress further or if the Apple modem transition accelerates, that ratio could become a concern. Something to watch. They also authorized a new $20 billion buyback program, so capital return is aggressive.
So Lana, bottom line on financial health?
Overall, Qualcomm's financial health is watchful. The balance sheet and cash generation are strong, but margin compression, elevated payout ratio, and cyclical headwinds in smartphones mean investors need to monitor execution closely over the next few quarters.
All right, let's talk about what Wall Street thinks. There are roughly 44 analysts covering Qualcomm. The consensus is a buy rating with a median 12-month price target of $185. That implies about 45% upside from where we are today.
The range is wide, though. Tigress Financial has a $270 target on the bull side. Seaport Global is down at $100 on the bear side. That spread tells you there's genuine disagreement about Qualcomm's trajectory.
Morgan Stanley has them at overweight with a $195 target. Any notable insider activity?
Not much to report. Q1 2026 saw 17 insider filings, but they were mostly equity compensation grants, stock awards, deferred stock units. Director Mark Fields received about 2,500 deferred units. No significant open market purchases, which would have been a stronger confidence signal.
And last earnings, Q1 fiscal 2026.
Beat on both lines. Revenue came in at $12.3 billion versus the $12.11 estimate. EPS was 3.5 versus 3.4. Automotive was the star at $1.1 billion in revenue, up 15% year over year. QCT overall was $10.6 billion, up 5%. QTL was $1.6 billion, up 4%.
Now, something interesting in the options market. In early March, put option volume on Qualcomm surged, over 97,000 contracts in a single day, 58% above average. That's institutional hedging.
Right. January also saw 47 unusual options trades with a 46% bearish lean. The options market is saying we see the long-term story, but the near term is uncertain. Certain. Smart money is buying protection.
Let's get into the bull case, because if you squint, this could be a really interesting setup. First up, Snapdragon X2 Elite for PCs. Qualcomm is going after Intel's lunch money.
And having some success. The X2 Elite launched at CES 2026 with an 80 TOPS neural processing unit for on-device AI. Early benchmarks show it matching or beating Apple's M5 in certain workloads while consuming 43% less power than the previous generation.
Design wins include Asus ZenBook, Lenovo Yoga Slim, HP, and the Microsoft Surface Laptop 7. This is the first real ARM-based challenge to x86 in the Windows ecosystem.
Second catalyst, automotive. This one is real and accelerating. Snapdragon Ride Flex is now in 8 global mass production vehicle programs. Design wins include Li Auto, NIO, Zeekr, Toyota RAV4, Next Gen. Automotive revenue hit $1.1 billion in Q1, growing 15% year over year.
Third, on-device AI. Qualcomm's Hexagon MPU delivers 45 teraflops of AI inference. That means running large language models, image generators, and AI agents directly on your device. No cloud needed. Privacy, speed, and no latency.
And fourth, IoT and robotics. The Dragonwing portfolio covers drones, smart cameras, industrial vision, and even humanoid robots. It's still early, but the total addressable market for industrial IoT is projected above $1.3 trillion.
Fifth, capital allocation. A new $20 billion buyback plus a dividend increase. Management is putting money where their mouth is.
Now for the bear case, and there's substance here. Risk number 1, Apple's in-house modem. Apple's C1 series custom modem is already shipping in the iPhone 16e, iPhone Air, and iPad Pro. The full Prometheus modem is expected by 2027.
How much revenue is at risk?
Qualcomm's iPhone modem business is estimated at over $8 billion annually. That doesn't disappear overnight. The supply agreement extends through 2026 and possibly beyond for mmWave support. But the trajectory is clear. Apple wants independence.
Risk number 2, China exposure.
This is the big one. 45 to 60% of Qualcomm's total revenue ties back to China, either through direct sales or Chinese OEM customers. The U.S. government has revoked export licenses for Huawei. Further restrictions are unpredictable. And Chinese competitors like MediaTek and Unisoc are gaining share in price-sensitive segments.
Risk 3, the ARM licensing dispute.
Qualcomm won the initial ruling in September 2025, but ARM is appealing. The core issue is whether Qualcomm's Orion CPU cores, developed from the Nuvia acquisition, require a separate license from ARM. An adverse ruling could force an architecture redesign and delay the PC roadmap.
Risk 4, smartphone downturn.
Global smartphone output is expected to drop more than 10% in 2026. DRAM prices are projected to spike 130% by year-end. That directly constrains OEM builds and hits Qualcomm's largest revenue segment.
And risk 5, margin compression.
The trend is clear. Gross margin has fallen from over 60% to 55%, net margin from 25% to 12.5%. Diversification into automotive and IoT is strategically smart, but those businesses carry lower margins than premium smartphone chips.
Let's do a quick peer comparison. How does Qualcomm stack up against the competition?
Broadcom trades at a trailing PE of 60.4 with 23.9% revenue growth and a 43% operating margin. Market cap of $1.59 trillion. They're the premium valuation in the space, and they're earning it with superior margins and growth.
And Marvel?
Marvel has a PE of 28.4, but revenue growth of 42%, the fastest in the group. Operating margin is only 14.7% though. Market cap of $93.7 billion. They're the high-growth, lower-margin play riding the AI infrastructure wave.
Yeah.
PE around 28, revenue growth of 12.3%, operating margin of 21.5%, market cap of $99 billion. They're Qualcomm's most direct competitor in mobile, dominating mid-range by unit volume, while Qualcomm holds the premium tier by revenue.
So Qualcomm is the cheapest on a forward basis, has the best free cash flow yield, but faces the most structural questions about its business mix.
That's a fair summary. The market is paying you to take on the transition risk.
All right, let's bring it home. The bottom line on Qualcomm. This is a company with a world-class patent moat, a fortress balance sheet, and nearly $13 billion in free cash flow. The diversification into automotive, PCs, and IoT is real and accelerating.
But the smartphone business is under cyclical and structural pressure. Margins are compressing, and the Apple modem transition is a multi-billion-dollar headwind that hasn't fully hit yet. The number I'd watch? Automotive revenue. If that segment can sustain 15+% growth and scale past $5 billion annually, the diversification thesis works. If it stalls, the bull case gets a lot harder.
We'll close with a quote today. Steve Jobs once said, "The only way to do great work is to love what you do."
Qualcomm's been doing this for 41 years. Whether the market loves them back depends on the next few quarters.
Before we go, if you want charts, tables, and the full financial breakdown, head to chargedalpha.com. Every episode has a companion PDF and video with all the data we covered today. Subscribe wherever you get your podcasts and leave us a review. It really helps.
And if you're new here, go back through the archive. We've got 93 episodes covering the biggest names in the S&P 500. It's the stock encyclopedia, one company at a time.
That's our deep dive on Qualcomm.
No pun this week, Hudson. You're losing your edge.
I was going to say Qualcomm is really on a chip and a prayer right now, but I held back for your sake.
Appreciated.
This is Charged Alpha, the S&P 500 stock encyclopedia. Charged Alpha is produced for informational and educational purposes only. Nothing in this episode constitutes investment advice, a recommendation to buy or sell any security, or an offer of any financial product. All data is sourced from publicly available filings, press releases, and third-party financial data providers, and is believed to be accurate as of the episode date, but accuracy is not guaranteed. Past performance does not indicate future results. Always do your own research and consult a licensed financial advisor before making investment decisions. Charged Alpha and its hosts have no positions in the securities discussed unless explicitly disclosed.
This episode was produced with the assistance of artificial intelligence tools for research compilation, script drafting, and audio generation. All financial data was verified against public sources. The hosts and producers are not liable for any errors or omissions in the content presented.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.